Hey, everybody. Good afternoon. It is Monday afternoon, and I am doing my podcast intro for today's episode number 1555. And I thought, what the heck? I might as well just go live and talk to all of you. This will only be for the intro portion part, though. The rest of the episode will be on the YouTube channel. So I'm just doing the intro with you, and I'm glad you could join me for it. All two of you who are watching on this surprise, spontaneous intro. Hey, actually, now it's four of you. And by the way, that only counts one of the platforms. So, anyway, just go through this real fast. Just a couple things I wanted to share here. Want to make sure a lot of you did yesterday on the live stream. I announced this. Go to pandemicinvesting.com and be sure to get your mini book on pandemic investing. That is 100% for free. And it's a great little primer on some of my 10 commandments of successful investing, but re-engineered just a tad for pandemic investing, because this is a time of crisis and a time of change, and we want to make sure that you are ready and equipped to deal with that. So again, free mini book at pandemicinvesting.com. And let's go ahead and dive into a few of these slides for those of you listening to the podcast that will be released later today. If you want to see the visual aids, feel free to just go to the YouTube channel and you can see them there. But I briefly talked about this before, and I think this is so critically important. It's the concept of shadow demand. And during the Great Recession 10, 12 years ago, we heard a lot about shadow inventory or shadow supply. Well, now I'm talking about shadow demand for housing. And this is a big, big deal. Here is just one of those shadow demand elements. And that element is young people who are living at home with their parents. And just see how significant this is. Back in the 30s, during the Great Depression, 1929 to 1939, 43% of young adults aged 18 to 29, so that's their age, 18 to 29-year-olds, lived at home with their parents. Now, that number went down. It was at a low point in the 1960s, and the generation of free love, the flower children, taking LSD, probably didn't want to live at home doing that, so they moved out on their own. Some of them lived in a commune in Northern California, right, or wherever, right, and so it went down to 29%. Then in the 70s, obviously, we all are pretty familiar with the economic hardships of the 70s, the era that stagflation was with us, that time where the Jimmy Carter Misery Index was discussed a lot, where you have high unemployment and high inflation at the same time. That absolutely stinks. It is a really bad economic scenario. So, it's going up, right? 31% of the people are living at home. But remember, housing was still very affordable back then. Then in the 80s, little more, even during the good times of the roaring 80s. The 90s got a lot worse. 2000s got even worse. And during the financial crisis, the Great Recession, the GFC, global financial crisis, whatever you want to call it, 10 to 12 years ago, depending on how you look at it, 44% of these young adults aged 18 to 29 years old lived at home with their parents. Well, guess what? Now, a whopping, the biggest in recorded history, a whopping 52% live at home with their parents. 52%. That is ginormous. That's a big, big number. And guess what? Of these millions and millions of young adults, they will not always live at home. They will move into the housing market. They will rent houses, they will buy houses, and that will be a very significant factor. We're looking at the last 120 years of data here, folks. And now, right now, is the largest number of these young adults living at home. All right. That is not going to last. It is not going to hold. It is not going to continue. And remember that these young adults really represent two generations. They represent Generation Z, the youngest of them, and they also represent Generation Y, or more commonly known as the millennial generation. 80 million Americans in total, but this is the younger side of that generation, right? The oldest millennials now are 40 years old. They're turning 40 this year. And we thought they were so young. They're not so young anymore, right? And they've moved into the housing market, but they've done it much more slowly than my generation, the Gen X generation, right? And so it's just interesting to watch this. I just really want to drive this point home because this is a big deal. This generation of people living at home that represents shadow housing demand. In other words, it's a shadow. It's not really there yet. We haven't seen it yet. We can see that it's casting a shadow that will come into the housing market and drive more demand in a market where housing supply is really short. Now, listen, I know that at any time in history, and especially now, there's no shortage of people predicting the end of the world. You know, the Zero Hedge website, which by the way, I love to follow. I think that's a fantastic website. They got some really interesting reporting. They've been predicting the end of the world since they started. Howard Ruff, the now late Howard Ruff, I'm pretty sure. Sorry if I got that wrong, but I'm pretty sure. He was on my show a few years back, and really interesting guy to listen to. Had a huge newsletter following. Back in the 70s, the 80s, the 90s, the 2000s, he was predicting the end of the world, currency collapse, deflation, inflation, both at once. I'm just telling you, what I'm trying to point out is that it's always these purveyors of doom that get a lot of media attention. Who was it? Ravi Batra, who wrote The Great Depression of 1995, which the complete opposite happened, by the way. And he was a hugely famous professor at the time for writing that and writing the book on that and all that kind of stuff. So look, you got to understand something. We are definitely in challenging economic times. Unemployment has skyrocketed. There is no question about it. We are in, serious problems. But at the same time, you've got to peel the layers of the onion. You've got to isolate that to really understand what parts of the market are truly affected. Remember, three types of housing markets: linear markets, cyclical markets, and hybrid markets. And I wish I had my chart of that here to share with you. I don't, but linear markets, obviously, slow and steady. This is the parable of the tortoise and the hare, right? Where the cyclical markets, the complete opposite. I do believe we will have significant real estate price adjustments in cyclical markets, especially high density cyclical markets. Here's the problem. Did you get that? Did I make my point by yelling? I hope so. Here's the problem. All of these people talking about market crashes never bother to isolate what they mean. They just talk about the real estate market or the stock market or the economy in general. And I don't know what that means. We are in a country with 400 real estate markets. 400 real estate markets, actually more than that. That's just looking at it as MSAs, or metropolitan statistical areas. And I believe the number's like 392, close enough to 400, right? 400. But in those areas, there are all kinds of different neighborhoods, price segments, density types, product types, condos, single family homes, high rise condos, low rise condos, garden style condos. Folks, you just gotta, people just do not isolate this stuff. They make these sweeping, frankly, very stupid generalizations about the real estate market. And what they don't talk about is that over the past 12 to 14 years, virtually nobody has been building entry level workforce housing. It's completely absent from the market. All of the focus in new home construction, as there has been this dramatic housing shortage with us really for decades. Now, there have been a couple times where the supply demand curve has shifted, but overall, we've had a housing shortage for decades. And, look at the price of housing, it's gone up, up, up. But interestingly, now with interest rates so low, housing has gotten cheaper for a lot of people. And that's why the market is booming. Then you add to it shadow demand, you add the mass migration from urban markets to suburban markets, out of high density cities, out of unfriendly jurisdictions like the Socialist Republic of California, my former home state, the Socialist Republic of Connecticut, New York, Massachusetts, Taxachusetts, all of these things. And if you are doing what the famous Wayne Gretzky said, right? You are skating to where the puck is going. You are going to be in very good shape. And that's what our investors are doing. And that's what we're helping people do. So, more on that, listen to the other podcast episodes, follow our other YouTube channel stuff, and you'll find more about that. Another thing I want to tell everybody to be very cautious about, and this really isn't hitting it on the head, this chart. This chart says COVID-19 set to decimate global airport revenue. This has already happened. I don't need to, tell you this. You know that the travel industry is on the rocks. It's been absolutely devastated. But airports in particular are a big expense and a big revenue generator for many municipalities. And what we are going to see in these high tax, business unfriendly, landlord unfriendly, civil unrest friendly, everywhere where they want people to riot in the streets, which is basically a Joe Biden political rally, that they won't stop because you can't, these are Joe Biden's voters. Okay. If you're going to put the kibosh and tell them they can't have the riot, then that's not going to be good for Joe Biden's campaign promises. And by the way, I just got a comment on good old Sleepy Joe, right? Who I mean, it's so hilarious. This political race has got to be the funniest. Here we've got Trump, who offends everybody on purpose. Then we've got Joe Biden, who is such a complete massive hypocrite. It's just comical, frankly. Joe Biden, who likes to call himself middle class Joe, that's exactly what he likes to call himself, middle class Joe. Do you know what his adjusted gross income was last year for middle class Joe? It was over $4.8 million. Yes, middle class Joe, over $4.8 million last year, almost $5 million. Not bad, middle class Joe. Not bad. But here's the reason I want to show you this airport chart, because it is just a proxy for the bigger thing that's happening. If you are invested in municipal bonds or any kind of security that depends on the success of a municipality, a city, a county, even a state, watch out. Make sure you are extremely careful. And a lot of you own these securities already. They're just buried into some fund that maybe your retirement plan is invested in, or some mutual fund that you have, or some managed portfolio of some sort, right? And in many of these areas, you are going to see massive, massive defaults. One other area that I want to really caution you about: CMBS market, the commercial mortgage-backed securities market. So there is almost no appetite right now for lenders to lend on certain types of commercial properties because they know that there is just massive default risk. And a lot of these securities attached to these commercial property mortgages, specifically in retail properties and well, retail is probably the hardest hit of them all. Okay, but second to would be office properties, right? Retail and office. You're gonna see just a massive amount of defaults, and you watching or listening to this may well have a lot of these securities already in your portfolio and you don't even know they're there. So do a checkup from the neck up and make sure that you are moving your money around to where it is safer. Very important thing to be doing right now. Also, if you're new to my content, I just want to say again, go to jasonhartman.com/start. That's jasonhartman.com/start. And of course, here today we're on episode number 1555. So if you're interested in our content, our analysis of the market, of economics, personal finance strategies, etc., uh, and you might not have time to listen to the last 1554 episodes of our podcast right now, right? Okay, fine. So don't do it. Don't do it. Just go to jasonhartman.com/start and listen to some selected episodes that discuss sort of some of the fundamental issues. Okay, and you can do that there. So just wanted to share that with you for people newer to our content or people who want a rehash of some of the fundamentals. Now, last thing before we get to our guest today, and our guest today is my friend Mark Moss, who will be with us in a moment. If you're just watching the live stream right now, this impromptu live stream, you're not going to see Mark here. He will be on the YouTube channel and the audio version on the podcast. Really interesting episode. So that's coming up. But before we get to that, I want to just share this chart, and this is public records of, and it's Redfin, the real estate company, analyzing MLS data. And this chart is very significant. Why is it very significant? Number one, it's totally current, just came out last week, and it says home price gains in August are the highest since 2014. And this is a year-over-year change in national median home prices. Why is that important? Well, as we were coming out of the Great Recession and the market was starting to gain steam, you saw it starting to gain a lot of steam in 2012. But that was still pretty early for a lot of people. A lot of people, number one, couldn't get financing. A lot of people had been foreclosed on, and so their credit was really beat up. And a lot of people were just plain fearful. They were scared. What is fear? False education appearing real, the acronym false education appearing real, or false evidence appearing real. To make it more contemporary from that old acronym, we'll just call it fake news. Fake news. We hear that one a lot nowadays. So, the market really didn't start ramping up in a hugely significant way until 2014. And then it was really getting some major, major momentum. And then, of course, we saw it bumble along. Sometimes it was up, sometimes it was down. The Fed was experimenting with, okay, is it time to raise rates yet? Is it time to tighten up the money supply yet? Because we've got to recover from all the quantitative easing programs and all this loose monetary policy, right? Remember, the Fed, the Federal Reserve, our central bank, or any other central bank around the world, like the ECB, the European Central Bank, or any other country's central banks, they all work to some extent in lockstep, coordinating their efforts. But our central bank, the Federal Reserve, is, of course, the largest and most powerful central bank in the world. And, they've got to have some ammunition for downturns. That's why low interest rates are so risky. They've got to get to a less accommodative policy as quickly as they can, because then they have ammunition to fight the next change in the economy. And they were doing that. They were doing that pre-COVID. They were stockpiling. They were in essence stockpiling. I don't mean that literally, but they were sort of trying to draw that loose money accommodative policy in a little bit, right? They were, the Fed controls the monetary policy, and the fiscal policy is controlled by the government, mostly Congress, mostly the House Ways and Means Committee, to be very specific. Very powerful committee that controls, the ways and the means, as the name would apply. The spending and the savings, right, of the government, and the tax policy. So as we see this happening, amazingly, during this time where everybody thought everything would be half price, everything would be super cheap, guess what? They were wrong. And I don't want you to miss this opportunity, because a lot of people right now are thinking, oh, there's going to be a big crash, but they didn't bother to segment that. Yes, there will be a big crash in New York City and Los Angeles and Seattle and San Francisco. Actually, you don't even have to say there will be. There already is. It is happening now, right? But it's going to continue. That's my prediction. Okay, it's going to continue. And non necessity housing in general, but especially high density urban core, right? But in August, the year over year change in home prices was the highest it's been since 2014. That was an 11% upswing, right? And this is just incredible. One of the things the market timers never account for in their analysis, they say, "Oh, well, I'm going to keep my powder dry and wait for the next downturn." Great. Good for you. Okay, fine. And you may be right. There may be a big downturn. Okay, sure. But you know what they never calculate? They never calculate the cost of waiting to time the market. Let's assume their predictions are exactly right. They nail it. They buy at the lowest point, and then they rent their properties for a few years and they sell them at the highest point. But guess what? In waiting to get to that point, they lost return on investment. So if you go to jasonhartman.com right now and you click on the properties page and you see what small number of properties are available there, and you see, okay, well, here's a property with a projected annualized return on investment, overall return on investment of, I'll just say 24% annually, right? All things considered. Remember, income property is a multi-dimensional asset class. So you earn your return on investment, your ROI, in many forms. So say altogether it's 24%, or maybe it's 28%, right? Okay, so say this collapse in the market starts next year. And great, it starts to decline, but you're keeping your powder dry. So you only lost 28% return on investment waiting 1 year, but now you're still waiting to ride it to the bottom. So if you're looking at this chart, right, you're here and you're waiting to ride it to the bottom, and then you get to the bottom, and say that takes another year. So now you lost 28% annually times 2 years. So you lost almost 60% return on your investment over those 2 years. But then you got to the bottom. And guess what happens to your psychology at the bottom? Wow, things are looking really bleak. I'm really scared. I don't know. Maybe I better wait a little bit for the news to improve. Okay, so say you wait 6 months and you lost now another 14% return on investment. So now you've lost like what? What's that? 72% return on investment, if my math off the top of my head is right. Okay, fine. Now now your powder that you've been keeping dry, all that cash you haven't done anything with, you now flood it into the market and you buy everything in sight. Good for you. You timed the market and you got it right. Pretty much, pretty much. Maybe you could have purchased 6 months earlier, but you got it pretty close. And and so then you did great, right? You lost 72% waiting, but because you got such a bargain, and you don't know what interest rates are then, so maybe you're paying a higher interest rate. probably won't be much lower than it is now, likelihood. Um, and then you really scored. And then you just got to figure out when to ride it to the top and when to sell. But what if you're wrong? What if that never happens? That decline that you were expecting? Then you simply lost that 72%, and you're either paying the same price now and the same interest rate now, or you're paying a higher price and a higher interest rate. This is why market timing is a dangerous activity. Okay. Warren Buffett, commonly thought of as the world's greatest investor, he doesn't do market timing. He just buys value and holds on to it. And we can argue about Buffett's strategy, whatever, but it's been pretty good over the decades. All right. So that's it for today. JasonHartman.com for more. We've got to get to our guest. I know a lot of you on the live stream are making comments, asking questions. I don't have time to get those to those today. We'll save them for the next live stream, or I'll just answer them on the podcast on iTunes. Just look up the Creating Wealth Show or go to JasonHartman.com, click on podcast, and you'll find all the links there for it. All right. Without further ado, let's get to our guest and let's talk to my buddy Mark about his predictions. We're going to talk about cryptocurrency. We're going to talk about the real estate market, the economy in general, monetary and fiscal policy. And here we go. By the way, just a reminder, again, if you're seeing this live, go to the YouTube channel, go to the podcast for the rest of this interview. If you're listening on the podcast, here we go to part 2 with Mark.